From San Antonio, Texas, home of the Alamo, the Riverwalk, and the World Heritage San Antonio Missions, this is the Exit Map Podcast, hosted by John F. Dini, the Exit Planning Coach. Designed to help advisors who work with business owners, John talks with top professionals in the exit planning field about best practices, marketing tips, and how to be more effective when working with owners. Now, here's John F. Dini.
Hi, and welcome to today's edition of the Exit Map Podcast, hosted by the Exit Planning Coach. That's me. I'm John F. Dini, and my guest today is Jeff Adams. Jeff Adams is the president of Adam Noble Group, a discrete, confidential business valuation, exit planning, and ownership transfer company. The firm has multiple specialties. They work in aerospace and defense manufacturing, oil field services, construction trades, craft breweries, one of my faves, patented products, partnership buyouts, manufacturing, service, and wholesale distributors. Jeff has successfully, wow, I'm tongue-tied today. Jeff has successfully completed the sale of over 800 businesses. He has personally started and grown 12 companies in fields from international finance to service and manufacturing. And he is a distinguished speaker at numerous national and international conferences on charitable giving, environmental, engineering, media, business management, business brokerage, and the M&A fields. Adam Noble Group can now handle the wide range of business exits, whether the owners are planning to exit now or in 10 years. And Jeff is a devoted husband, proud father of 6, world traveler, sportsman, and tennis player. Welcome, Jeff.
Well, thank you, John. Appreciate it. Appreciate the opportunity to talk with you.
It's exciting to have you on. You and I have talked before, not on the podcast, and you're an interesting guy that does a lot of cool things. Tell me, how did you get started in the M&A world?
I would say very much accidentally. I was involved in the sale of not of my businesses, but of other businesses. And a gentleman up in Chicago, who was one of my clients at the time of a company that I owned, basically made the comment of, why don't you consider selling my business? And at the time, I recall laughing and kind of saying, I don't know anything about the sale of companies. And he says, no, I've seen what you've done with, with a particular business. And given that, I would think that you'd be really successful. So he introduced me to some other folks that were based in the Dallas-Fort Worth area, got talking with them. And, before he knew it, even though I'd kind of semi-retired at the time, all of a sudden I had a shingle going out. And in fact, my first client was this manufacturing company, ink manufacturing company up in Chicago.
Ah, well, you were semi-retired 3 decades ago?
Hmm.
Good for you. Yeah, there must be a secret there that I will never get.
No, I think good luck. Good luck.
That happens too. You know, the author of what that wasn't The Secret Millionaire. It was a book that was real popular about a decade ago about the millionaires.
So about 30 years ago, there was a book called The Millionaire Next Door. I don't know if that
The
might be one.
Millionaire Next Door.
Yeah.
That's what I'm thinking of.
Yeah.
Yeah. He wrote a sequel to that.
Okay.
And in it, he interviewed a bunch of millionaires and he tried to poo-poo the results, which I thought was funny because when he scored them, the wealthier the person was, the more he attributed luck as the major factor.
Well, that's interesting. And again, if it's the same author, for his first book, I remember reading it, and I remember being surprised that one of the top sources of millionaires' wealth was entrepreneurship, number one.
Hmm.
Number two, one of the most common businesses to own at that time, and again, this is like 30, 35 years ago, I'm gonna guess,
Yeah.
was dry cleaners. And the
Wow.
interesting thing of it is after that book came out, it ended up generating a bunch of dry cleaning franchise models. And I don't doubt for a second that it came exactly out of that, folks looking at this.
Huh.
And then, as you fast forward 15 years afterwards, the dry cleaning industry was an extremely difficult industry, overdeveloped, too many, small franchises that started up. So it's just interesting that sometimes, if you fail to learn from your history, you're doomed to relive it. And to me, that was a good example of it.
You started it, you hung out a shingle. Describe a typical meeting with a new prospect.
So our model really hasn't changed much in 3 decades. It really starts, it is absolutely a questioning approach. So we do less speaking and more listening.
Hmm.
Our first meetings, I would say that 30 years ago, meetings were always in person. Today, they're actually rarely in person. They're very much a video call, not unlike what we're doing right now. And in fact, they're all over the United States, whereas 30 years ago, it was basically in the Dallas-Fort Worth area. I remember in the first year, I had set a goal of representing 12 businesses. I think I actually listed 14 in the first year, including the one in Chicago, and sold and closed the sale of 12 of them in the first year. And the group of brokers that I was involved were a bit surprised at that because most of them, their experiences were pretty different. In most of their cases, it took a year to 2 years to have the first couple of closings.
Mm.
Then you would build up and kind of go from there. But part of that model in the first year of just kind of listening to the owner was trying to understand, not unlike what kind of the exit map model was, what's the ideal exit for this owner, not just in the sale of the business. You know, I think that in the sale of a business, people often think, especially if they're not the owner, that the owner's biggest concern is a pot of gold, pot of gold at the
Right,
end of the day.
right.
And in my experience, that's not the case. I think, very much in line with kind of how the exit map model is set up. It's really about life after sale. So it
Mm.
is what is the sale of the business going to allow me to do in terms of resources, in terms of that pot of gold as an example. But is that going to allow me to do and accomplish what I want, whether I'm an individual owner or whether I'm part of a partnership, or whether I'm considering a partnership buyout, whatever the case might be. So, our initial our process over 30 years from that perspective, is relatively unchanged in terms of it's really focused on listening. Today, we ask different questions than we did 30 years ago.
Sure, sure. Not the specific questions, but what shift do you see in the types of questions you ask?
Well, I think that you know, over the course of 3 decades, the things that make a successful exit are different today than what they were 30 years ago.
Hmm.
And the part of that is just in kind of the baby boomer aging, in terms of the age of the owners. Initially, I would say that probably the majority of owners that we were dealing with were in their 30s and 40s. Today, that's probably 60s and 70s. In fact, I've sold a company for a gentleman that was 96 years old, who
Wow.
had restarted his business for the third time, the second time post-retirement, at the age of 91. I sold it for him 5 years later. So, the reality is that you start focusing, I think, more on the future, especially as we get older, so as we get maybe further away from birth, from our birth year. So those questions, adapt relative to the where we are in the time continuum.
We've been, as you're probably aware, we've been in the middle of doing a little rebranding with Exit Map.
Mhm.
And the tagline on the website now is the fastest way to lose a client is to treat the exit as the finish line.
No, absolutely.
Yeah.
That's absolutely sage, and that comes from empirical observation, I'm sure.
Oh, yeah. 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 We argue all the time that too many people are just advisors, not the business owners. If the business owner is just focused on the amount of money, it's more ignorance than anything else. They need some help and some education. in understanding it's a lot more than that.
Correct.
But so many advisors are just focused on the money. And I don't mean the commission, I don't mean the sale as much as it's all about the money. And once I do that, I've done a great job, which, as you know well, is not the case.
Yeah, and that's a great talking point too, because things that make entrepreneurs successful, the ability to be task focused, very, I mean, literally sometimes very, very narrow focused, are not the things that are important once you get to the exit. Because again, you can get that pot of gold, but it's not necessarily going to get you what you want. And have you really thought through as an ownership team, what are you going to do with your time after the sale and after the transition? Because something's got to replace that.
Um, we talked at the outset about the different industries that you specialize in. Now, entrepreneurs, as you just said, are largely entrepreneurs. I mean, they have certain traits, they're goal oriented, they're focused, they're single-minded in many cases. But the industries that they go in are very, very different. Which factors or which ones do you find really interesting or really different, and which do you find the same?
That's a great question. We really don't do much in the retail space, and quite frankly, part of that is because the retail space and the restaurant and food service space, as an example, tend to be more cookie cutter. And I don't mean that in any way to diminish the role of the
Hmm.
owner in terms of in the role of the business that they built and the profit and success they have with their employee teams. But there's a reason that there are more franchises in that space, and that's because you typically can come up with a cookie cutter type recipe for success and then reapply it. Although ironically, with a franchise model, it's literally set up to maximize whatever the minimum expectations are of the owner. And what I mean by that is to build a business that's no bigger, because if they build that franchise to be too large, then that's going to minimize how many franchises can be sold across the country. So it's kind of
Hmm.
interesting in terms of going in a different direction. Um, the ones that are more interesting, though, I think are really the niche businesses. I've been involved in some things I would have never ever dreamed of. The multitude of ways that you can meet a market's requirements and make a lot of money doing it, even if you're not focused on making the money, is just incredible. I mean, I've seen catfish farms, which I would have never thought of. I sold a business that just a wonderful gentleman owned, um, Kyle Tolman, a young man, basically kind of a plumbing background. Um, and he started driving with friends, taking his four wheelers and kind of going underwater and needing to traverse, a river or creek or lake, or if you're a deer hunter, whatever the case might be. And he kind of saw what his buddies had and said, you know what, I can come up with something better than that. And he took his plumbing background, got the parts, did the plumbing, and then plumbed his ATV with a snorkel, and ultimately formed a company called Snorkel Your ATV, which was the biggest company of its type in the United States when we sold it. And we sold it to a strategic competitor that has bought it and expanded the product lines. But all of these little type of niches are just so
Yeah.
much fun. The people that you get to know through the process, the passion that they have, the amount of times many of them have been told no, that your product or service isn't going to work or you're not a good fit in this industry, and they just do an amazing job to accomplish, amazing things that on the surface you might have said, probably weren't doable.
Yeah, it's great. I run peer groups and have for 30 years now. And one of the criteria that I say makes a great member is you're just fascinated at the ways people can make money.
Mhm.
Yeah. I'm going to take a break.
Amen. Amen.
Oh, go ahead. Yeah, I'm going to take a break so we can pay for the podcast. And then when we come back, I want to talk about commissions and fees and success rates in the industry. I'm with Jeff Adam of Adam Noble Group, and we'll be right back.
The fastest way to lose a client is to treat the exit as the finish line. The surest way to keep one? Make what's next part of the plan long before any transaction. Exit Map changes everything and turns next step planning into your strongest retention tool. Exit Map is the only structured discovery system built to be the first step in every advisory relationship. The 5-meeting process helps advisors guide owners through the essentials of successful transition planning, financial readiness, business readiness, and personal readiness, so they gain real clarity about what life looks like after the business. You guide the process by facilitating deeper conversations. They own the plan by discovering their own priorities and defining what success truly looks like. The result? A documented set of goals, a personal vision, and a prioritized action plan. Built by the client, giving them clarity about their future and giving you a roadmap for supporting it. Exit Map. You guide it, they own it. Take a test drive at exitmap.com.
Okay, welcome back to the Exit Map podcast. I'm talking with Jeff Adam, the president of Adam Noble Group, and we've been talking about his M&A practice. Jeff, you are a mid-market M&A,
Correct.
lower mid-market. When I sold businesses for a while, I was a true business broker, Main Street broker. In the Main Street brokerage world, the success rate consistently year after year from the IBBA, they publish it, is about 20% of listings. They fail about 80% of the time. And a lot of that has to do with the businesses they list. But in your case, your success fees can be quite substantial. Have you ever had a situation where a business sale was progressing, was going to be sold to a particular buyer, but then you just realized it was not a good fit?
Yeah, and again, a great question. Appreciate the question. Um, our fees are typically or can be in the hundreds of thousands of dollars range. So um, that can be a hard thing to walk away from if you're the advisor, especially if there's a team. We have a team here at Adam Noble Group, and everybody shares in the success fees. But one of the things that we have indoctrinated in everyone is, from an integrity perspective, if it's not the right fit for the business owner, even if they think it's the right fit, we're going to do everything we can to demonstrate to them as to why it wasn't a fit with what their original goals were in the exit, especially for them and for their family and for what they want to accomplish. And certainly, if red flags come up with regard to the buyer, even though the seller and the ownership team might sometimes that pot of gold that's about to be realized is such that it can affect your thinking. Certainly in the advisor's case, but I'm really talking about more in the ownership case.
Sure.
So yes, we have had situations where even though the seller, the ownership team wanted to sell and close the sale with the buyer, we literally have talked to them, talked to the owners, and even gone out and reached out to their legal team to explain and document in writing why we don't recommend that they proceed with it. In one case, we had a company with patented products. We had a very substantial offer with an earnout. But as we went through the quality of earnings and due diligence process, it really became clear that the company, the acquiring company, that was not a public company, it was a privately owned company, but we became aware of some integrity issues that were going on. Shared that with the ownership team of our client's ownership team. And they felt that while they were important integrity issues, they didn't feel it was something they were about to sell the business anyway. And my comment to them is that that's not the biggest issue. Part of your, 30% of the value of what you're going to get, relative to where you are in your product cycle is going to be based on this licensing arrangement. And if the buyer doesn't have the integrity to correctly report things because they're not publicly traded, it's not going to be easy to audit those. And we recommend that you don't proceed with them. So, literally send a letter to the ownership team, to their attorney. and they decided to go ahead with the sale. So about 6 months after the sale, and our fee was very substantial. About 6 months after the sale, I got a call from the owners. There were three owners, and two of them got on the line and said, "Listen, we're having this issue." And I said, "Well, what's the issue?" The issue is we know now that the distribution, we have some evidence that the orders are not fitting what they're actually reporting in terms of licensing, and they're paying their fees. And at that point, I said, "Listen, we'll do everything we can to help you, but this is exactly the issue that we were
Yeah.
talking about." And the problem is that you guys, it was two guys and a girl. You really had other plans with other products that were not related to the sale of this business, but that this sale was going to partially fund in terms of further product development. And now you're likely going to be embroiled in a collection process and lawsuit. And unfortunately, those things don't happen over a short period of time. But
No,
let's get you
nor are they inexpensive.
exactly,
Yeah.
absolutely, and nor guaranteed. And so I said, let's get your attorney on the line and talk this through, because really they're going to be the lead person, the lead company in terms of trying to go through this. I had a second case too, where again, a substantial offer, multi-million dollar offer in a business. It also was a patented product, consumer product in the recreational industry. And sole owner, they were happy with the deal, wanted to move forward. And we basically helped them understand that, look, through this process, we've explained to you that there's three areas in your business that if you were to address these areas, instead of selling your business for 7 million, we will likely be able to sell for 15, 16, 17 million. And it's not going to take you that long to get there. You're probably looking at 2 to 3 years worth of work, a few $100,000 of capital investment, because this was a service business. One of the three, as an example, was promoting something from within so that the owner would spend more time working on the business than in the business.
Mm-hmm.
So with the letter of intent that was in place, we had the ability to terminate. Both parties had the ability to terminate. So seller terminated, took the business off the market. So fast forward, actually almost 5 years later, I get a text on a Saturday morning. I'm sitting with my wife, having a cup of coffee, just talking about our day. And I get a text from an unknown number. There's a number showing on the caller ID, but I don't recognize it. It says, and literally the message says, "Okay, I'm ready." So I looked at it, and my wife says, "Don't respond. This is spam." I said, I think this is someone who knows me and that I know, and I think that they've changed their cell number and they don't realize that they've changed their cell number. I'm going to respond." So basically responded something to the fact that, sorry, my caller ID isn't identifying who's this, if you don't mind, you've got me a disadvantage, who is this? And basically the person responds with their name. I knew exactly who it was. So I said, "Great, fantastic. Do you want to talk this weekend or do you want to talk Monday?" He said, "No, no, no, let's talk Monday." So we spoke on Monday. We ended up selling the business for almost 17 million.
Wow. That's
A,
great.
a great reference, great referral, great testimonial, but most importantly, that owner listened, didn't take that pot of gold that was there, which was substantial, and decided to spend some more time, energy, and effort, and ended up really, really enjoying the rest of the ride, not even including the final pot of gold that was involved with that sale.
That's great. That's great. Um, you bring up something, and we need to wind it up, but the it's kind of like the reverse of what I wanted to ask you. You said in this particular case, you told an owner that with some work, his company could be worth a lot more. More frequently, as you well know, owners come in with an expectation of value that is not realistic.
Mhm.
You know, I've seen a survey that says on average, owners overestimate the value of their businesses by 35%, which
That might be
seems reasonable.
conservative, but
Yeah, I was going to say I've seen a lot more. Yeah, but, you know, what do you do in those cases? How do you address that with the owner?
well, I think it's a good process is going to have this as one of the possible outcomes in the situational analysis. So that first, the questioning process, the assessing of the business, the understanding of what, the owner's goals are. And I think if you do that in a holistic approach, not just focused on the transactional sale of the business, I think that you can do what we call gap analysis. So let's say the business is worth, 5 million and the owner's expecting 10 million. That's what they need to retire. If a situational analysis was done correctly, it will have identified two, three, four areas that are really the big value drivers for the business. So in our case, as part of our situational analysis process, if that line in the sand, the value of the business doesn't meet the requirements in terms of, the exit, then our process also includes, taking the time to help the ownership understand, what are the key areas to drive, what has to be accomplished in those, not how to do it. The owners best know the business, the entrepreneurs best know their business, but they can go and then decide, do they want to take the, time, energy, capital investment to go and do that. And I think if that is explained up front, that's part of the process, I think it makes this a very, very not easy step in the process, but it's one that the ownership team, will understand. They'll know that, look, this was one of the possible outcomes, and it's simply part of the process, and we're going to, continue the process until they decide, do they want to take the time, energy to go and improve the business, increase its value, and then kind of come back to a future exit that then allows them to accomplish what they want to do after closing.
You know, yeah, the respect of truth saying. Uh, and usually I finish this up because, as you know, many people are coming into the industry now, putting themselves out as being able to plan the exit from a business. I mean, the boomer tsunami is full upon us. Um, as a matter of fact, they just showed me today, EPI, which is the leader in teaching exit planning methodologies, had their November class was over 300 professionals. I mean, they're
Wow.
just, they're minting them at a very rapid rate. And I usually ask guests what would be their advice to somebody entering the industry, but I think you've already addressed that quite well. Listen, understand that the money isn't the whole thing, be truthful. Is there anything you want to add to that? I think that's three pretty
No,
good ones that you brought up.
well, and I appreciate that, and obviously didn't, know that necessarily was going to be one of the questions, but I think one of the things I would add to that is it's about, I'm going to also call it philosophy. You can your life or your career or your relationships can be transactional, or they can you can be in them for the long game. What's the long view? And my approach has always been, and my belief has always been, it's about the long view. You never know when you're going to come back around. John, I know you travel a lot. We travel a lot. We just got back from Egypt. But you're going to meet people, whether it be in your travels, whether it be in your day to day, whether it be at the grocery store, whether it be on the side of the road when you stop to help someone, change a tire type thing. And you never know when you're going to come back and meet them again. And you never know how they could help you in the future. And that's not your goal isn't to position that
Right,
relationship so that they can help
right.
you in the future. But the reality is everything is so interconnected. I had lunch with one of my sons today, and we actually talked about this point, and I told him, I said, it's this very, very small world. And his response back, which was kind of tongue in cheek, says, "Well, Dad, it's either a small world or you're just traveling a lot of the world." I said, "No, it's a small world. It really is a small world." And if you kind of conduct your life and your business model, and to me, if you're getting into exit planning, in terms of, look, you're planting a lot of seeds. Number one, understand you've got to put food on your table for your family. I get it. But those seeds, are going to be, are going to come to fruition in the future in the way of relationships, referrals, additional business, and just richness of friendships. Um, so it's well worth doing things with a view to the long term, not to the short term.
Great. Thank you. This has been a terrific conversation. Jeff, for those that are listening, obviously anybody that sees this in print or online will have your contact information, but just tell us the website where they can find you.
Yeah, best way to get a hold of us is just go to our website. It's adamnoble.com, and I'll spell it out. It's ADAMNOBLE.com. So again, adamnoble.com. That's the best way to get a hold of us.
Great. Thanks for coming today. It has been a real pleasure. I've enjoyed it immensely, and I will be seeing you soon.
All right. Take care, John. Appreciate
Okay.
it.
Thanks a lot, Jeff. Take care.